Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. And look, the sun is out. At last, I can stop moaning about the weather, at least for one day, and with it brings hay fever. It's ridiculous, isn't it? I hope you're able to enjoy the sunny weather without feeling like you've got a massive head cold as well. In terms of what we've got for you this week, we've got some really interesting stuff actually. So we've got our usual roundup as what's been happening with lenders. There have been some changes. They're very, very small positive changes at the moment. So no one's doing anything crazy, really changing the dial, but we are seeing lots of very small positive changes, which is very, very welcome at the moment. We're then going to talk a bit about predictions on base rate for the rest of this year. There's quite a few different schools of thought at the moment. There's a lot going on in the mix. We're just going to talk a bit about that and how things might shake out there. We're going to talk a bit about what's happening with banks and their kind of squeeze on the mortgage market going forwards, particularly with all the things you've heard in the news in relation to Silicon Valley Bank and that kind of stuff. And then also finally, we're going to talk a bit about landlords retiring. There's a big lump of landlords who'll be hitting 65 this year. We're going to talk about how that's going to impact the market as well. Now, before we get into all of that, I just want to say that Mortgages for Business are really looking forward to being at the Property Investor Show at the Excel in London on Friday and Saturday of this week. We're going to have a stand. I'm also going to be presenting on both days, and I think I'm also on a panel debate as well. If you are at the Excel and you do come along, we'd love to see you. We're at stand number 430. It's quite a big exhibition, so 430 is where you'll find us. For those of you who aren't aware of the Property Investor Show, it's free to attend. It's a huge exhibition hall full of people who can talk to you about all things property related, so whether it's insurance, it's about sourcing property, tax, mortgage advice, furniture, all this kind of stuff. There's loads of really fantastic businesses there who are looking to speak to you and tell you how they might be able to help. So if you are there, we'll look forward to catching up with you then. Okay, so first up, lenders this week. So we have seen some rate movements from quite a few lenders. We've seen the Mortgage Works priced down by up to 50 basis points across their range. So their 2-year fixed rates are now from 3.69 and their 5 years from 3.99%. The Mortgage Works is a lender, so they're owned by the Nationwide Building Society. They're a huge lender, probably I would say the biggest buy-to-let lender in the UK at the moment. Their offering is really good. What I would say is because they're a lender who lends at volume, there isn't a lot of kind of scope for anything that's grey. So you really do either tick the box, and by box I mean their computer algorithm, or you do not. Anything that requires someone to apply a little bit of thought to it probably isn't really for these guys because they are a volume-based lender. But actually, if you fall within their kind of remit and their criteria, dealing with them is largely a very, very joyous experience because things tend to move through very, very quickly. The other thing I really like about the Mortgage Works actually is their existing borrower offerings. So the rates they offer to existing borrowers are super competitive, almost on par with what you would get as if you were a new borrower going in. So that's really encouraging. They can lend to landlords with portfolios of all different sizes. They split their offering into landlords with 10 or less and 10 or more than 10 properties. So large portfolios and small portfolios. But first-time landlords are also fine as well. So they can kind of lend to anyone with a portfolio of any size. They're also able to do limited company lending, no more than 2 directors and shareholders, though their computer systems don't allow for more than 2 named borrowers on the application. So that can restrict who can go to the Mortgage Works in terms of limited company lending. And they're looking for very, very clean SPVs, so no layered companies or anything like that. They also do HMOs as well, small HMOs. So really, really solid offering, and great to see them bringing rates down. When the Mortgage Works does something, all lenders will be looking from the sides to see what's going on, and because these guys are so large, anything they do really kind of echoes across the market. So well done at the Mortgage Works. So we've also seen the Coventry reduce their pricing. Again, this is really only for their lower loan to value pricing sets of 50 to 65% loan to value. And we've also seen the NatWest reduce their rates by between 1 basis point and 25 basis points. We've seen Platform Home Loans make some reductions of up to 49 basis points on their fixed rates. Conversely, they've been increasing all of their variable rates. Their reversion rate has gone up by 25 basis points. It's now at 7.12%. And their tracker rates have also increased by 25 basis points. This is all just a direct fallout of base rate going up. Previously, they just hadn't made those amendments. They've done so now. Now, we've seen Foundation Home Loans make some reductions to their special edition products or limited edition products. So their 5-year fixed rates on this basis are now down and starting from 5.39%, which doesn't sound awfully exciting, but it does have a flat arrangement fee of just shy of £5,000. And this is available for loans of up to 1.5 million. So putting that into context, when we think about some of the other 5-year fixed rates available, and this is specialist lending now, so limited companies, HMOs, multi-units, people with really huge portfolios, no minimum income requirement, all that kind of stuff. When we put that into context of some of the other 5-year fixed rates where lenders are charging a percentage arrangement fee, actually by paying a flat arrangement fee of £5,000, this works really well for larger loans, not necessarily for little tiddler loans. If you're borrowing £75,000, this wouldn't be a great deal for you. If you're borrowing 1.5 million, this would be an absolutely brilliant deal for you. They've also brought down their pricing across the board by up to 75 basis points as well. So some pretty chunky reductions actually from foundation home loans in the last week. Now we've also seen Molo make reductions to their pricing. We've seen Alderman Mortgages make some reductions to their rates. Nothing overly exciting. We're sort of talking 0.1, 0.15%. So again, it's these small little changes that we're seeing right now. And we've also seen Landlords launch a range of limited edition rates. These start from 4.99% from 5-year fixes. Arrangement fees start at 5%, so 4.99 with a 5% fee, and then it works its way up, so you get to 5.59 5-year fix with a 2% fee, and they've literally got a product with a 5% fee, 4% fee, 3% fee, 2% fee, and a flat fee as well. So the full kind of complement of rates there. So I think in the round, not a bad week from the lenders, actually. Good to see some pricing coming down. Like I say, for those people who are waiting for that kind of real hallelujah moment where everything drops by 1%, hopefully this will really kind of reinforce what we're saying, that you're just not going to see that. And that's going to be further underpinned by what's been happening with swap rates in the last week. So as of this morning, 5-year swap rates are at 3.895%, so just under 3.9 now. 1 month ago, they were just over 3.5. Why are they going up this time? I mean, it must be so difficult for people to really know which way to go in terms of pricing money. The latest thing is because of the news about the oil production and therefore oil prices going up, which means actually there is now more concerns about inflation in the UK. Obviously, if our oil prices go up, it impacts everything. And so there's now a real risk that we're not going to be back down at the sort of 2-3% inflation levels that everyone's been really kind of hoping for by the end of the year. That then in turn has made the money markets quite nervous. Swap rates have gone up. So like I said, I think really the message now is these higher interest rates, these elevated interest rates, or as I'm going to refer to them, I think for the next few years at least, the more normal interest rates, this is kind of where we are in terms of pricing. I know there's people we've been speaking to really since the mini budget actually, who are waiting for rates to come down. Obviously things have come down from the real spike from the mini budget, but actually what we're not going to see is any significant drop-offs now. We're kind of where we are, and you can see this with the way swap rates are behaving. So for those of you who are sitting on really high variable rates of 6 point something, 7, 8%, I think probably, if I'm really honest with you, this is kind of it now for the time being, and it's probably, you know, a good moment for you to now consider locking into your fixed rates. Okay, now we have had a couple of bits of criteria change, which have been quite interesting. So first of all, Molo have launched into multi-unit freehold blocks, so essentially blocks of flats, so more than one self-contained living space on a legal title. Now they can do up to 6 self-contained units on one title, which is very, very standard. 75% loan to value. They do need you to have at least 12 months experience of letting as a landlord before they will consider offering one of these mortgages to you. Why is that? Because if you've never let a property out before and then you buy a block of 6 flats, that's quite a step up from no letting experience. It's only having 6 of them to run, so they do want you to just have a bit of experience behind you. Now what they do say is that all units must be separately saleable and serviced for utilities. Now this is very, very common. We get quite a lot of inquiries come through for people who have multi-units where actually the services are shared. So for example, every property runs off one gas bill, so the landlord or the owner, the freeholder actually ends up paying for it, generally speaking. Lenders don't really like these. There are some lenders who can consider it, but most lenders want each property separately metered, have its own council tax, all this kind of stuff, so it can be sold off individually. The reason lenders like it to be this way is because if they needed to repossess the property and sell it on, probably not, what they're not going to do is sell it off as one block of 6 flats. Probably what they're going to do is sell it off as 6 separate flats, 6 separate leaseholds. And so actually the ability to be able to just kind of break it up and sell it quickly rather than having to do actual works to the property to get things sorted is very, very appealing. So like I say, most lenders require this, but not all of them. The other thing that that Molo offer, which is something which is really neat, is something called a savings booster, which is a bit like, they don't call it an offset account, but it is a bit like an offset account. And I'll cover this off in a different episode because it's quite long to explain, and we've got loads of other stuff I want to share with you today. But actually what they do across all of their products, not just the multi-units, is offer a sort of offset facility, which is really, really neat. Pricing from 5.19% here. Now, the other thing that I wanted to share with you in terms of criteria is we've seen Santander change their rental calculations. That's come down. So the rental calculation was 125 or 145% coverage at 8.25 if you were taking anything other than a 5-year fixed rate. That's now gone down to 7.59. And on 5-year fixed rates, it was 125 or 145% coverage at 7.25. That's come down to 6.09%. Are they the best in the market? Absolutely not. But actually, that's quite a big reduction, which means that people would be able to borrow a lot more money than they could previously with Santander, which is really great news. Okay, now I read an article the other day about landlords retiring and how many landlords are going to be retiring shortly. I just found this super interesting. So around 140,000 landlords retired from the market last year, which accounted for nearly 3/4 of all landlord sales, with the figure expected to grow over the next few years as older landlords retire. Now, this is according to Hamptons, who said there are 96,000 landlords turning 65 each year, and there are around 1 million landlords who are already above the age of 65. The report continued that these landlords who retired last year were among the first to take buy-to-let mortgages when they came to the market in 1996. Hamptons have added that over the last 12 years, the number of landlords retiring annually has nearly doubled, from nearly 80,000 in 2010 to around 140,000 in 2022. And the report said that over half the total number of outstanding buy-to-let mortgages were taken out between 1996 and 2007. It explained that this cohort of ageing investors who bought when the sector was growing were increasingly likely to sell up and cash out. They leave behind a gap which is not being filled by new landlords entering the sector. Excuse me, Hamptons has said that 45% of homes sold by landlords so far this year was built at least 15 years ago, which is up from a third in 2018, has been growing ever since. So what we're basically seeing here is that there's a bunch of people who bought buy-to-let properties sort of 20, 30 years ago. However, now they're basically retiring and they want out of the market. They can cash in, they can get their capital out and sort of sail off into the sunset. So actually this really is accounting for a large number of the or reduction of buy-to-let properties available in the market. It's interesting, isn't it? Because actually when I think about buy-to-lets, I mean, I've got a buy-to-let for my retirement. It's not an income now. I intend to benefit from it when I retire rather than now, but I guess a lot of people have used this as supplementary income, or it means to build up a savings pot they can then access when they hit retirement. But the key message here is that actually this really kind of gives a very good explanation as to why we're seeing such a large number of landlords exiting the market at the moment, and therefore which is really shortening supply of rental properties against this backdrop of a market which is showing increasing demand. And unfortunately this just means that, you know, demand will continue to even more significantly outstrip supply, which is going to continue to drive up rental figures. Okay, now there is a lot of speculation about what's going to happen with base rate this year, and I feel like every week I'm coming to you with a new reason about why swap rates are remaining elevated. And the swap rates remaining elevated implies that people think base rate is going to stay elevated or even increase. So it's very interesting to read an article which is written by the Ernst & Young Item Club, who basically, Ernst & Young are a large accountancy firm, a management consultancy, and they have they produce economic reports essentially giving their thoughts about what they think is going to happen with the market. So you think these guys would absolutely know what they're talking about. So here's their version of events. What they have said is that they forecast base rates going to rise to 4.5%, but they then are expecting to be cut in winter and continue to fall over 2024. So they're expecting one further base rate increase, and then things are going to start coming down by the end of this year. Now, Martin Beck, who is the Chief Economic Advisor to the Ernst & Young Item Club, said that high inflation had been a challenge to the UK's economy, but this is set to cool. He added, despite challenges in the global banking sector and falling inflation, another rate rise at May's Monetary Policy Committee meeting is probably more likely than not, following a better than expected economic performance. Indeed, a stronger economy might mean inflation takes longer to cool down this year. But on balance though, we think base rates should start to come down from this winter. He said that the emergence of disruption in the global banking sector has added a risk to rising interest rates and the real economy. UK credit conditions could tighten if global financial volatility were to have an impact on banks' funding costs and lending appetites, and this would create another headwind for the housing market, business investment and consumers looking to use debt to compensate for the squeeze on their spending power. House prices will also continue to fall, with a 10% decline over the next 2 years. So this is their kind of prediction on what's going to happen. And like I say, there are many schools of thought available, and this is just one of them. Excuse me, but I did think this one was worth sharing because I think this is the one that's had the largest amount of kind of news coverage. And lots of people have been emailing me saying that they've heard that base rate is going down this year, and I suspect this is where it's kind of come from. So that's the kind of story behind that particular news article that you would have seen. How do I feel about that? What do I think? I'm not convinced personally. I do think there could be another base rate increase in May, incidentally. Will rates be coming down by the end of the year? That's the bit that I'm not quite sure about. While we're continuing to see costs go up, excuse me, and people keep getting pay rises to keep up with it, inflation is going to remain elevated basically. So at that point, while inflation is still high, the Bank of England base rate is not going to be coming down. So let's see what happens. But that is Ernst & Young's thoughts on things for you. Now, it's interesting that the Ernst & Young Item Club referenced credit availability within the market, because there is some nervousness around this. So interestingly, separately, I was reading a report which has said that they are expecting banks to start putting a squeeze on credit availability in the second quarter of this year. And that's on the back of increasing defaults on business and household loans and general borrowing as well. So what they're saying is that actually across the piece now, so households and businesses are all starting to really feel the squeeze by double-digit inflation and all the many interest rate rises that we've seen. And this is really starting to see an increase in defaulting. Excuse me, Bloomberg Economics expects the UK to avoid a recession this year, but it is warning that tighter credit conditions are a key risk that may worry some Bank of England policymakers. So they are saying that banks are expected to rein in home loans, but they're also, this is going to be balanced by the fact there is going to be a surge in demand for mortgage borrowing in the coming months. Actually, demand for home loans in the second quarter of this year is expected to jump to its highest level in 2 years, and that's because there is a real kind of chunk of people whose mortgage rates are coming to an end in quarter two by the end of the first half basically of this year, where these people have been putting off making decisions, waiting for interest rates to come down, and they're actually getting to the point where they can't continue to kick the can down the road. They have to make a decision. So I think it'll be interesting to see what happens with the banks. I mean, how are we seeing this in the real world? We're actually not hearing of any kind of reined in appetite in terms of lending at the moment. Will that come through? Let's hope not, but it's not a given by any stretch of the imagination. If we do start to sense that people are starting to rein things in a bit, we will let you know. And actually, I think that lenders are probably largely just watching and waiting to see with their default rates on their loans how bad things actually get. But the fact that we are seeing an increase of things, of defaults picking up, means that we may see lenders start to really kind of revisit their back book, look at the kinds of things which are defaulting and making slight amendments to credit policies there. So we'll keep you posted on that as and when we have more news. What a busy week for news items this week. Look, I thank you so much for joining us as always. And as you know, if you have any questions, we'd love to hear from you. 0345 345 6788. Have a glorious Wednesday. Enjoy the sunshine. I think it is our last day of sun for a few days. So let's enjoy it while we can. Hopefully we'll see some of you on Friday or Saturday at the Property Investor Show. And for the rest of you, I will see you again at the same time next week. Look after yourselves until then.